So yeah, I think it's a pretty frustrating time for a lot of traders out there, because the markets are really finding it really difficult to find a direction here. We are in this Goldilocks situation right now where macro assumptions are, pointing towards inflation cooling. I mean, obviously, UK's number this morning doesn't prove that, but broadly, at least more so in the US, there are indications that inflation is cooling, and growth projections are not looking as bad. Recession is not looking as bad, so those concerns are cooling off as well. So I think overall, yeah, it's really getting difficult for the markets to find a direction, and I believe the next trigger would really just come from this ongoing earnings season right now.
But in terms of what that means for equities then, okay, so inflation potentially cooling, but it's taking a long, long time. The chance of a pivot to cutting rates, again, questionable for the second half, fourth quarter of the year as well. What do our equity viewers do with this current environment?
I think, yeah, we have to understand where we are coming from, where, with the banking stress that we saw in March did lead to a lot of these rate cuts being priced into expectations for the Fed and the likes, right? But inflation numbers have really not supported the case of such aggressive rate cuts this year, at least. So that really needs to be driven out of the markets. And that means that once those rate adjustments happen, it will be a time for at least the rate sensitive parts of the equity market to be concerned about those movements there.
Yeah, I think the point about earnings is well taken, Charu, but do you think that we have clarity on the guidance that we've been given so far? Depending on who you listen to, either the analysts have taken them down too much or not enough. I know Credit Suisse's Jonathan Golab was pointing out that the drop in estimates going into the season has been bigger in magnitude than historical trends. And yet, as we've seen some of these numbers come through, they haven't been that awful.
I mean, yeah, right now, I think, again, we are just a couple of weeks into the earnings season, so it's really hard to draw conclusions at this point. But I would agree with what you said earlier, again, coming from a base in March when we saw the banking stress and we thought credit conditions could potentially tighten a lot because of the risks of a banking crisis, that really has not materialized. And if that remains an idiosyncratic risk right now, that means that all those downward revisions that we saw for earnings may also have been a little bit more aggressive. A very similar story to what's happening on the macro front as well, where the rate cuts have been aggressively priced in, as we discussed earlier. So, of course, coming from that, there is a risk. But, again, US inflation is cooling. So the pricing power of a lot of companies is going down, whereas the labor costs are not cooling. So the margin pressure story is certainly the one to monitor, I think, again, in this quarter. And that is where my focus is.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.